Hi, here we'll understand some basics of income tax laws and aspects relevant for taxpayers, especially individuals, heads of income, taxable income, deductions, total income, tax liability and all that stuff. Let's begin with some basics. Income tax is a tax levied on a person's income where a person includes individual, HUF, cooperative societies, LLPs, partnership firms, companies, trusts, etc. In this video, we will focus only on an income tax of an individual. Since we have already understood income tax is levied on an individual's income, but what income? Taxable income. In simple words, taxable income is an income on which tax is levied or computed. We will look at how to calculate taxable income, understand few basic deductions, exemptions, etc. Before we get into important concepts and actual computation part, we need to understand that there are two tax regimes available this year. One, the old tax regime, the other, new tax regime. Let us understand the difference between both. Under old tax regime, a taxpayer can claim deductions of HRA, LTA, LIC premium paid, medical insurance premium, interest on housing loan, etc. But under new tax scheme, he cannot claim all these deductions. Then what's the difference? We'll come at the next point, which is the tax slab difference. Under old tax regime, there are three tax slabs, that is 5%, 20%, 30%. But under new tax regime, we have 5, 10, 15, 20, 25, 30. You can see the tax slabs under both new and old schemes. Understanding the taxable income first. Step 1, you calculate your gross income from salaries, which includes all the aspects of salaries, that is basic salary, DNS allowance, HRA, LTA, special allowances, etc. received during the last year. Then you subtract exemptions, mainly HRA and LTA. For HRA, you can claim only if you stay in rented house. HRA will be claimed as a least of the following amount. Actual HRA received 50% of basic plus DA if you live in metro cities and 40% of basic plus DA if you live in non-metro cities. Actual rent paid less 10% of basic plus DA. However, this exemption is not available for those who have opted for the new tax regime. If you own a house or live with your parents, you cannot claim HRA. Then subtract standard deduction of 50,000 provided by government. Yeah, this deduction is not available for those who have opted for the new tax regime. Now you arrive at the net salary. Next, you add income earned from other sources like rental income, capital gains, income from saving bank interests, deposits, etc. One thing to note here is that if you have opted for the old tax regime and have taken any housing loan, the interest portion paid during the financial year can be claimed as a house property loss, which will eventually reduce the gross total income. You'll arrive at gross total income, to which you subtract deductions under chapter 6A. So if you are into new tax regime, you'll have to wait till the step 3. Step 2, you calculate the amount of deductions. The most popular chapter 6A deduction is the ATC. You can claim any amount invested by you in PPF, EPF, equity linked oriented scheme, Sukanya Samriddhi Yojana, or any amount paid towards life insurance premium or towards the principal payment of house loan. Next, you have deduction under 80D for any insurance premium paid for self, spouse or dependent children for a maximum of 25,000. If you have senior citizen parents, that deduction is extended up to 50,000. You can also claim deduction under 80 CCD 1B up to 50,000 if you have made any deposits into NPS account or any contribution made through Atal Pension Yojana. You also have section 80 TTA, which provides deduction up to 10,000 on interest income from saving banks account with banks, cooperative societies or post office. Note that this benefit is not applicable if you earn income from FDs, recurring deposits or interest income from corporate bonds. Last but not the least, 80G. It was one of the most popular section during the pandemic times. Yes, your donation to PM Care Funds, PMNRF or any other NGO, trust which can be claimed under this section, you can put it here. For section 80G, you will need the name, PAN and address of the donee, and of course the amount donated. Donee is a person to whom donation is made, in case if you are wondering what is donee. After subtracting the chapter 6A deduction, you will arrive at the total taxable income. Step 3, you calculate your tax liability as per the applicable tax regime. So if you have opted for the new tax regime or if you opted for the old tax regime. Let us now understand with the help of an example as to how to compute the tax liability. Suppose Mr. A and Mr. B earn an income of total 15 lakh during the last financial year. Both have eligible deductions under Chapter 6A of up to 1,50,000. Here you can see that Mr. A, who is under the old tax regime, can claim the deduction of 1,50,000. Eventually, taxable income is reduced by 1,50,000. But on the other hand, Mr. B, who cannot claim the benefits under Chapter 6A, his income remains the same. So to this, we apply the tax rates applicable as per the old and new tax regime. As you can see, Step 4, you consolidate the tax liability and adjust TDS, TCS as applicable or any self-assessment tax that you have paid. Hope this video was informative and useful. Thank you for your patient listening.